Hello from Altered Markets. This is Ahura. We'll be with you with the FOMC last meeting of FOMC in 2024 and market reaction. As always, first let's check what we had as a decisions, and then we can see how we should expect from this decision, what we should expect from this decision in financial markets. Decisions, kind of there are two. Before I have to say, before I start, I should say that in this meeting the decision was expected. 25 basis point rate cut. That was the decision. That was expectations, and that's what happened. However, it was not what we were looking for in this meeting. We were looking for four items: the tone of the statement, GDP expectations, interest rate expectations, and interest rates, inflation rate expectations. So inflation, GDP, statement tone, and economy. These four options was what we were looking for, and to see how Federal Reserve is expecting, how Federal Reserve is thinking about that. About the first one, about the statement, the tone in the statement. Fed meeting, after the Fed meeting, usually we have the statement right after the meeting when they announce the interest rate, they publish the statement as well. The statement usually at the beginning of 2024, mostly it was focusing on inflation, and was always telling, was always showing us that the main focus of the central bank in the United States is to control the inflation, while they were always mentioning that the focus of the, the Federal Reserve is, the mandate of the Federal Reserve is controlling the inflation and the maximum labor market, maximum job markets. However, this usually at the first meetings of 2024, since the inflation was higher, usually central bank was focusing mostly on the inflation. But later that changed, and in the last meeting and the meeting before that, usually they were focusing more on the unemployment rate, as unemployment on the job market, as unemployment rate increased to up to 4.3%. However, now we can say that labor market is also gets some stability when we are looking at the initial jobless claims, and also continuing jobless claims on one hand. When we are looking at the GLTs, usually we see that we can see that the numbers in the labor market also are fine. That's why now the Fed is focusing. The Fed says that the risk of labor market, the risk in the labor market and inflation is balance, so there are the same risk in the market. So that's why we cannot say that which one has more for now, which one can get more focus of the Federal Reserve, or it can be at the first stage of the focusing, or the first level of attention. No, there is nothing right now. What the Fed says that the balance of the risk between the labor market, unemployment rate, and the inflation rate is the same. So that was the first one, which is the positive for the economy. So that one is first positive signal about the economy. Let's go about the honors: GDP, inflation, about other three, which is the GDP, inflation, and interest rates. Let's start with the interest rate, expected interest rates. What we were expecting, what the Fed was expecting, and what we were market expecting a little. The Fed in the September meeting was counting on 4 rates cut, each time 25 basis point for 2025. However, market was counting on 3 rate cuts for 2025, which means based on the Fed expectation in September, they made interest rate for 2025 was about 4.4. But after last night meeting, yesterday meeting, the Fed now is counting on 2 rate cuts for 2025. That was the biggest change and paradigm shift that happened somehow, we can say, in the market, because now we are not expecting 4 rate cuts, we are not expecting 3 rate cuts, we are expecting only 2 rate cuts in 2025. That was the biggest change that happened. So now we are expecting 2 rate cuts for 2025 4, which is the 4 point, I mean, sorry, market for September in September, Fed was expecting 3.4 as the interest rate for 2025. That changed to 3.9 right now. So from 3.4, it changed to 3.9, which means that the interest rate we will have only 2 rate cuts in the interest rate in 2025, which can, as I said, which is a very big step to the hawkish tone. The same changes happen for 2026 and 2027 as well. Only in the long run, we are expecting to see that's another option. That's another change also that happened here. The natural rate changed to the 3%, the long run, which is the natural rate, changed to the 3% from 2.9%. It's increased, which means right now the Federal Reserve expecting to maybe even they change their inflation target from 2% to change it between 2 and 3%. I mean, they can make some changes from 2% target to between 2 and 3% targets. So because the natural rate is 3% right now, so the market is counting on 3% inflation for as a normal inflation. Other options. If we look at the GDP for 2024. But in its previous expectations, it was expecting to see the 2% GDP growth for 2024. Now they see 2.5% GDP growth. Same for 2025, from 2% GDP increased to 2.1% GDP expectation, and in 2006, 2% is unchanged. Generally, what the Fed is expecting to see, the better economic growth for 2024, 5, and 6. At the same time, the expected inflation for the PCE inflation is 2.4% right now for 2024, which was 2.3% in its previous expectations. And the biggest change is for 2025, where the Fed now expecting 2.5% as PCE inflation, which it was 2.1% in its previous expectations. Same for 2026 and 2027, the numbers changed. And the core PC price index, which is the Fed preferred inflation number, is changed to 2.8% from 2.6% for 2024. And for 2025 also, it changed to 2.5 from its previous 2.2%. So generally, the Federal Reserve is expecting better economic growth with the higher inflation. So at the same time, when you're looking at the labor market, the unemployment rate expected is 4.2% for this year, which was 4.4% in previous expectations. And for 2025, it's lower to 4.3% from previous 4.4% expectations. That means that in the long run, the unemployment rate is set at 4.2%, which is, we can say that the full employment level. What we are expecting right now, we can say that the Federal Reserve expecting to see the better economic growth, while with the better economic growth, lower unemployment rate, higher inflation. That was the reason why they decided to hold the higher rates for longer. So that was the surprise. With this surprise that happened right now, with the surprise that happened, we can see right now, with the surprise that happened, let's check where is the, let me share my FedWatch tool. Let me find the FedWatch tool. Okay, here, I found it. With what happened here in the meeting, now generally the market expecting only 8 points. There's only 8.6% expectation for another 25% rate cut in the Fed meeting in January. So generally, we can say that the market right now they're counting on holding the current rate in January, as generally we are expecting only 2 rate cuts in 2025. So that was the biggest change that happened in the GDP growth expectations, in inflation growth expectations, and unemployment rate market. And generally we can say that the Federal Reserve is more positive about the economy and economic growth in 2025. Even for 2024 as well. Let's go and check the market reaction. So let's see with this market, with these numbers and data that we had, what we can expect from the market. After data published, US dollar index increased about 108 mark. We were expecting to see a high in the previous that we were writing. We were expecting to see a little bit stronger US dollar after the meeting. However, we were expecting only 3 rate cuts for 2025, and we're expecting to see the US dollar index around 107, 106.60, 107, but not 108. That changed a little bit market, that 2 rate cut expectation changed the market tone, which increased the US dollar index above 108 mark. That was the big changes. For now, what we are expecting to see generally, we were positive about the US dollar trend, we're getting closer to the year end. So with this change that happened, even if we will have some corrections around this number, and we can see the US dollar lower twice to 107 mark, but generally we're expecting to see US dollar stronger US dollar in next days. So about the US dollar, we are still positive. We can say that even after some correction, US dollar can hold its gains, and especially getting closer to the year end. With stronger US dollar, we had some pressure on the gold price. Usually it's AU US dollar, gold against US dollar. We had some pressure on US dollar on the gold price, but however, what we can see in the market say that the things that happen in the market, we can say that they're getting closer to the year end generally. Usually by the historical trend, if you look at the historical trend, we can say that usually gold is getting more demand by getting closer to the year end and new year. So even if US dollar didn't have that much correction after its fall, after its increase, but gold almost concluded its fall of yesterday's fall, and it's going to go higher. So we're expecting to see the gold in higher levels, still in higher levels, and we are still positive about the gold. On the oil market, we can say that they even thought that that the higher rates means stronger US dollar, higher rates, pressure on the stock markets. That means the negative news for the oil market. But at the same time, the oil markets are positive because generally what we can say here that why the Federal Reserve holding their rates higher, because they're expecting the better economic growth in the United States. At the same time, in China also, we are expecting to see the communist the government put the 5% Chinese government put the 5% economic growth, GDP growth expectations for 2025, which is a positive about the growing in the market, Chinese market, and they are generally positive for the oil price. And we know that the previous OPEC meeting, the OPEC monthly report also increased the market demand for 2025 to 103 million barrels a day. So generally, we are not negative about the oil price. So that market, that news could not impact the oil market too much, especially we know that the oil market depends on the geopolitical tensions, which is still high. Last night, Israel attacked the Houthis, some Houthis port in Yemen. So generally, all these news can hold the oil in a higher in the current level. So we are still positive about the oil, about around the $70, $1 or $2 higher or lower, but generally we are positive about the oil market. On the stock market, since the decision was much dovish than expected, much hawkish than expected, and this hawkish affects the stock market with like free fall in S&P 500 from 6,000 almost 50 to lower to 5,850, but still That was an initial reaction after we know that the 10 days before the Federal Reserve meeting, usually the FOMC members, they are in silent mode, they cannot talk, but after the meeting they can still they can go back to the speeches and they can have some comments. What we're expecting to see after such a hawkish decisions, most probably the Fed members will have some dovish comments next days, which can support the stock markets, and still we are expecting to close the year in S&P 500 above 6,000. Uh, between the stocks that last night they closed they lost they lost the position, they lost the steam. We can say that the Nasdaq had more lost, closed hot lower, and the correction also in a Nasdaq could be slower. And I mean, S&P 500, we're expecting to see some more gains. For the Nasdaq, we're expecting to see less gains. Same for the Dow Jones as well. The Dow Jones gains can be less because higher rates for longer means very bad news for the production, for the retail sales, which the most Dow Jones members, Dow Jones list is are the factories and retailers. So which means that these news cannot be such a good news for Dow Jones, for Dow Jones 30, but for Nasdaq, or especially for S&P 500, could be we can give some chances for correction in the next days. On other market, we can say that on the Bitcoin market, we are still positive about the Bitcoin market because first of all, the only important reaction of the Bitcoin in the speeches was where reporters asked Mr. Powell that will the Federal Reserve going to have the some Bitcoin reserve. The Fed denied that, say that we have no plan right now for that. This is what the Senate and the Congress the Congressman and House can decide about that. They can decide about that next year. So somehow it was a negative reaction to the cryptocurrency market. But since we are expecting the higher inflation for 2025, that higher inflation usually is the positive for the Bitcoin market, for the cryptocurrency market. Therefore, we can say that the Bitcoin can take advantage of that, and we are still positive about the Bitcoin, especially as long as it is trading above 101,000 US dollar per Bitcoin. I have to mention earlier today we had a central bank meeting in Japan as well, which also held the interest rate at 0.25%, which was somehow more. The thing is that with what happened last night in the day before in United States, with the higher rates in United States and lower rates in Japan, we can see more carry trades, and these more carry trades means that the more people they are going to sell their yen to buy the US bonds, which is really negative news for the Japanese market. We can say that at the numbers yesterday we had Japanese export increased by 3.8% in November, but import fell by 3.8% in November, which means which means that the weaker Japanese yen can put the Japanese economy under pressure and can increase the import prices, can increase the the Japanese usually they import the energy, they usually import the raw materials for the factories. This higher price for the energy and raw materials will increase the production price, and this production price can increase the PPI and then CPI, and that can increase the inflation, general the headline inflation in the market. This headline inflation, so weaker Japanese yen will end to the higher inflation, and Japanese central bank should think about that. I think the Japanese central bank, they had a little bit more, they were more somehow over dovish right now, and probably they should change their outlook about the economy and the Japanese condition. Most probably in January we will see 25 basis point rate hike, because with this condition and this Japanese yen, this rate of Japanese yen, it's going to be in more risk. This is what's happening in the market in the United States and Japan, and the market reaction in the different markets. If you had any other question, don't hesitate to write in the comment section. I will try to get back to you as soon as I can. Have a good time. Bye-bye.